Welcome to Market Matters, presented by Mike's. I'm Joe Teagay of Equity Armor Investments. Thank you to everybody joining in. Means a lot to me that you are here. Remember, we are every Monday at 1 Eastern time, right after lunch. You can get the big volatility news of the week. And this week, there is a lot to talk about when it comes to volatility, to say the least. We're going to get through all of it. But the story that is on top of everybody's minds when it comes to a currency crisis is the yen and the weakening of the yen. And is this going to cause some sort of cataclysmic event? Well, I'm here to tell you, in spite of the fact that it would be good for my book, it would be good for my book if volatility exploded. I don't think this is going to be it. I think this is something that we could stomach as we go through it. So again, thanks for coming. It really means a lot that you are here. And let's get into the weekly preview this week. So as I mentioned, everyone's talking about, we can get our slides up going. Everyone's talking about the yen and the currency crisis. It has significantly weakened. It has gone up to levels we haven't seen since the 90s. The yen is really, really falling very quickly. And it's led a lot of people saying, oh my gosh, if this were to unwind, there's a carry trade and everyone's going to have to sell their treasuries and rates are going to go to the roof. And, I don't necessarily see that happening. If that does happen, the market will be able to eat it up. I think people will be out there looking to buy them, but we'll get into that as we go. Now, into the weekly preview, big week this week. I was talking about a jobs report, always used as the earnings report for the economy. We got the FOMC. They will be meeting. They'll be taught. There's no projection. There's no dot plot, but their policy statement is always critical. It's always critical to hear what they have to say, and that will be a market mover. The market will react to that. Interest rates will react to that. We know how sensitive the market is to interest rates right now. And last week we had a lot of earnings. Well, this week is no slouch itself. Already had SoFi this morning. We have Amazon, AMD, Apple, SMCI, Qualcomm, PayPal, Eli Lilly, Coin, Square. That's a lot of earnings. There's obviously more besides that. So lots of potential movers out there. It should be really exciting and fun to watch from an options trader perspective. Jumping into the volatility report, as I see the man of the hour could be joining us soon, the volatility man of the hour. We had volatility sky high last week. We had volatility last week, in the 18, close to 18. And hello, Brian, welcome to the show. We're talking about sky high volatility last week, and it has come down in a big way. We foreshadowed that last week, Brian. We talked about the SKU index. We said, hey, I know things look rough right now, but history suggests volatility is going to fall. And what happened, Brian?
Yeah, it did fall. And you look at this volatility curve, it basically gives an indication of mean reversion, right? Because when you look at 1 month ago, 2 months ago, a lot lower than we were last week. And now we've seen that sort of drop back down and renormalize back to its mean level. And so, if the rally continues, I do expect this whole entire curve to sort of shift back in line to where we were a couple months ago. Don't you think, Joe?
I think that's exactly right. Feb and March, we saw the SKU index at relative lows down here. This was what we were pointing out last week. We had this SKU index collapsing, going down, and volatility. Let's take a look at it. This was the last week's chart, actually. Volatility had yet to make a new low here, Brian, and there was some skittishness, there was some nervousness, there was hotter than expected inflation, there was weaker GDP. People were concerned for a hot minute, but volatility knew. Earnings came out and just smashed it. We had Google out there flying higher. People just saying, hey, this AI trade is for real. This AI trade is going to be, the story for the next 2 years. We're buying more chips. On Friday, we saw the semis take off off the recent lows.
Yeah, we did. And really, what this SKU index means is we've used this as a sort of a fear and greed sort of indicator, because what happens is institutional traders, option traders, what happens is they sell puts, they buy calls, right? They're buying calls because they want to participate on the upside. And that skew index shifts, it goes lower as they become these call buyers come into the market. And as we saw, the VIX and the rest of volatility remain elevated, although not making new highs. That too then follows suit, and has started to collapse as well. And it seems like the rally is back on after a little bit of a 5% pullback.
Yeah. So what's happened this week? The volatility index is spike index. The VIX index came down to meet the skew, exactly what the skew was predicting last week. Now, if you look at the past few times the skew has come off, it does kind of go to the relative lows. So it does suggest that we could see a skew down here and a VIX at the relative lows. We'll wait and see how that plays out. But following the FOMC, following the jobs report on Friday, does stand to reason without any major event that volatility will fall further.
Yeah, and all these are bullish signs. So, we'll see. Obviously, big Fed meeting coming in this week, and that's really our story of the week, right, Joe? We're talking about the currency trade. We're talking about how this volatility is affecting the rest of the market and rippling through. And you look at the seasonality as well on the technicals. They sort of line up. This little pullback was expected, right? I mean, look at that, Joe. I mean, we got overextended,
Yeah.
And so what happens in an election year is you get this over exuberance. The new president maybe is going to stick, maybe he doesn't, or whatever. But the seasonality trade says that we're going to consolidate and we're up for the rest of the year.
Yeah, remember June, July, August, usually great months in election years, especially when there's an incumbent president. Incumbent presidents have a lot of tools at their disposal, and maybe it's one of the reasons why they typically win. But be expecting the cards to be played for the president to get this economy working at the right time.
Yeah, but I really, Joe, I want to get into this big story because this is really interesting topic to me, and I think people have to listen in on. There has been so much fear about dollar yen and what the yen is doing, but let's just take a step back. Let's just see what the U.S. is doing first. And when you look at the Fed interest rates, expectations have now shifted to none. There are more people expecting no cuts. That's up at 17%. The people that were expecting a couple cuts have really dissipated and gone away. And now we're sitting at, one, slight possibility of two, and maybe some people now saying none.
We were bringing this chart up in January, Brian, and we're like at 4 or 375 on a lot of these instances. And we were just saying that is crazy. The market's come back to reality here, but yeah, it is fascinating the recent shift we've seen just with this hotter than expected inflation. There was just a recent shift from 3 cuts down to 1 is kind of being the base case right now, but 0 cuts is gaining momentum too. And in reality, that is the story of a hotter than expected inflation, which is exactly what we have.
So if we have 1 cut, and I really expect that to be the most, and maybe no cuts, Joe, what happens to that dollar yen trade that we talked about here?
Yeah, so let's get into this dollar yen trade. Let's unpack it and exactly what it means, because there's a lot of fear mongering out there going out there in the Twitter sphere or X sphere. I don't know if there's a way to call it now, but on X, on the internet, people are just going crazy that this is going to crash the economy. And I think that would be good for us, Brian. We're long volatility traders. But we're not going to sit here and just say, hey, that's going to happen. You should buy some volatility today because setting up for this event, because, we want to build a little credibility, just be realistic here. Just let how we're thinking. We're not just going to go out there and sell fear and say, hey, the sky is falling every week. I am concerned legitimately about a few things down the line. I think the fact that we're probably going to cut in spite of the fact that hotter inflation is a worry for the long term. The fact that the U.S. government spending too much money is a worry for the long term. But in the short term, this yen situation, it's a carry trade. It's a risk for some people, but it's not a risk to the stock market broadly.
Yeah, and I think if we just take a step back, I think we have a chart, just the dollar yen going further back in history. And you look there, we're not even close to where things were at in the 1980s in terms of the weakness in the yen. And, maybe Japan just wants it to get back to there. That's when their economy was doing better. That's when they could export more effectively. I mean, they have an aging population. The technicals line up in this sort of like head and shoulders bottoming process, breakout to the upside. This trend of a weakening yen has been going on now. Look at this, going really back over a decade. So I think the trend is just continuing. I don't think it's anything really new. I know we may become a little bit less dovish, and certainly it seems like Japan is really becoming, well, they always have been dovish, but as when we sort of stabilize our rates, it's obviously the carry trade. People want to sell their yen, buy dollar, and get the higher interest rate here in the US, and that's probably caused our 10-year note to be probably subdued to some degree in terms of interest rate levels, and that's why we have this inverted yield curve, or one of the many reasons why we do. And so that probably continues to persist, but I don't think this collapses things, right?
The problem persists. We have that yield curve's a little bit more inverted than it needs to be, but effectively, our interest rates are higher, their interest rates are lower. We're exporting some inflation to them. We're just we got too much inflation. You take some of it. Is essentially what's happening here. And for Japan, they're probably saying, I want to go back to the 70s and 80s. That's when we were the emerging economy. That's when we were exporting as much as we could to the United States. People, thought we were going to take over the United States back in that time period. So I think it makes sense for them to want their currency to appreciate. Yes, it does make things more expensive because they don't have any oil or petroleum, but there's a lot of other benefits for them. So I think they are okay with it. And the fearmongers are out there saying, hey, if this trade has to unwind, the people need to dump treasuries. Interest rates are going to go even higher. Well, yes, I do think that is a potential, and that could hurt stocks for the short term. But as we saw last week, stocks go down for a little bit. People are going to say, hey, what's the price of NVIDIA? Oh, I'm going to buy it.
Right. And frankly, unwinding that trade would probably re-invert the yield curve here. And that's probably good for financials and banks. So that's, one way to play it. Like if you think the unwind is coming, then I would want to be long financials. But we're not. We're a little bit underweight financials, frankly, because we just think this is just a blip, and this is a thing that probably continues. And look at the technicals. I think that price target on a breakout head and shoulders here would put the yen above 200. So if I was a futures currency trader, I'd be betting the yen continues to weaken.
Well, let's move on to the big story, or the big stock of the week. Last week, Brian, we hit another home run. We had Alphabet. We played it to the long side. They crushed their earnings. We were talking about this earlier. Just another story where this AI story just continues to materialize. The infrastructure build out continues to be there. The implementation is starting to come online. This is still the early stages of this AI story, and the big companies are the first and foremost of it. And Google just absolutely crushed, and our trade here is up 250%.
Yeah, it is. It's been a nice winner. Obviously on this kind of trade, our price target of 190 on Google, I expect that still to hit come July, this summer month. So I'm still holding a similar trade that I put on a little while ago, even before this, on this type of trade, betting that Google continues and Alphabet continues to move higher. But I think the real interesting play now, the next one up, Amazon. Joe, how are you playing this? This chart looks phenomenal that this trend continues to the upside.
Yeah, no, remember, this isn't advice. This is not something I'm suggesting to anyone. This is something I'm just looking at personally, and for some clients. This is what we've been looking at in the big term of Amazon. They had a huge sell-off in 2022, as a lot of technology stocks did, as interest rates started to climb high super fast. And they've had a tremendous recovery. And they've actually had a head and shoulders bottom here, Brian, as you can see. That was about $64 from 144 or $145. We'll call it $65 from this point. We'll draw it here, right there to down there. That was $65. So my target on that head and shoulders would be $65 higher. We've come a long way, but we haven't gotten to that $65 target yet. That would be a new all-time high. That would be $200. Brian, I think what we saw for Google do it after earnings, I think Amazon, there's no reason they cannot do the same. So I am looking at the weekly 180, 200 call spread for 7.25. Sorry, for 615. That would be wonderful if that turns into $20 for me, and I would get a better than 3-to-1 payout.
Yeah, so obviously the break even is still a little higher. You're going to outlay some premium on this and have some risk, right? Because this is a weekly option. If earnings don't come out that well, that $6 is going to go close to, going to get to zero very quickly. So this is somewhat of a binary event that I like to call it binary, meaning it's either going to happen or it's not. But I think it's a smart bet. So if I was sitting down at a casino, I probably wouldn't, go to Vegas and put all my money just on this one trade. If I want to sit there and play for the whole weekend, I do think the odds are in your favor, Joe, on this trade, because I like it in the sense that it has a high probability of success given the AI story, what we saw out of Google, hopefully Amazon repeating in this situation, and then you get this payout that is roughly, call it 3-to-1 payout on a trade like this, should we hit those higher levels.
Yeah, based on everything we've heard recently with AI, people needing cloud, I think that bodes well for Amazon. Based on everything we've been seeing with prices going higher, I think that bodes well for Amazon. Wages aren't really going higher as fast as prices. I think that bodes well for Amazon. So basically, I think I've got a better than 50-50 shot they beat earnings. I'm getting a 3-to-1 payout on that. I think that's a really good proposition for me.
Yeah. So this makes a lot of sense. This is an interesting trade. We've gotten it right on a whole bunch of different AI plays here. So, this is something we continue to watch, and we'll continue to update not only this trade, but bring you another one next week.
And, just wanted to let everyone know, if you got any questions about this trade, other trades we've done in the past, anything else we've said earlier in the show, feel free to comment. Remember, every week we are here live 1 Eastern on the Tradier Hub. Love to have you join in and chat with us as we're going through these.
And Joe, I got one last question. What do you think the Fed says come Wednesday?
I think the Fed, believe it or not, is going to say we're data dependent. And we're watching it as we go. I don't think there's going to be much change from their language from last time. I think the market's going to interpret that as, oh, well, inflation's higher than it was. They're probably looking at 2 cuts rather than 3. And I think ultimately, I'm leaning towards 2 cuts, Brian. I think the Fed's going to be more dovish, not because they should be, but because they can be.
Okay, well, we'll be watching closely come Wednesday. It should be an interesting, fun week. Fed jobs number Joe brought up at the beginning of the show. So this has been a great show. Please tune in, like and subscribe, not only our channel, Equity Armor, but come and check out Tradier Hub for more trade ideas and video here. This show, Market Matters, sponsored by the MyX. We'll bring more at you every Monday, 12 p.m. Or 1 p.m. Eastern, 12 noon Central. More to come. Tune in next week. This is Brian Stutland of Equity Armor Investments.
And I'm Joe Teague of Equity Armor Investments. Have a great week.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.